Welcome back once again. If you haven't subscribed to this channel, please do so, so that anytime I post a video, you'll be the first to get it. So today we'll be looking at IAS 23 borrowing costs, and I'll be laying the foundation in terms of the theory in order for you to understand what this whole borrowing costs is about, right? So when we talk about borrowing costs, it's simply finance costs or the interest costs. So IAS 23 borrowing cost regulates the extent to which entities are allowed to capitalize borrowing costs incurred on money borrowed to finance the acquisition of certain assets, right? So we all know that sometimes when organizations or individuals are buying certain assets, they do not buy it cash. They go to the bank, get a loan to buy the asset. It could be a plant, it could be some form of machinery, and they go to the bank to get this loan. And you know that banks do not give free money. And so there's always a borrowing cost for that loan that is received. So IAS 23 is given as guidance as to what exactly to capitalize when it comes to borrowing costs that is used to finance the acquisition of certain assets. Not just borrowing costs, but borrowing costs used to finance the acquisition of certain assets. Very, very key. Very, very important. So that's what IAS 23 is looking to do. And borrowing costs can be capitalized as part of the cost of an asset if the asset is a qualifying asset. So what IAS 23 is telling us that these borrowing costs must be capitalized. That means it must be recognized on the balance sheet or the statement of financial position as part of the cost of the asset if that asset is a qualifying asset. It's a qualifying asset. So you add the borrowing cost to the cost of the asset and capitalize it. But you may be asking, what is a qualifying asset? It's a technical term, right? A qualifying asset is one which necessarily takes a substantial amount of time to get ready for its intended use or sale. That's what we mean by a qualifying asset. One that takes time to get ready for its intended use or sale. So like a plant, it takes a while to, install a plant and make sure that everything is working and everything is fine. Like some of these huge plants that you have in factories, it takes a while to install them. So borrowing costs must be capitalized as part of the cost of the asset if the asset is a qualifying asset. Now let's talk about commencement of capitalization. Commencement, at what point do we begin to capitalize? At what point do we begin to capitalize? IAS 23 states that capitalization of borrowing costs should commence when all of the following conditions are met. It should commence when all of the following conditions are met. Very, very important. So what are these conditions? What are these conditions? Number one, expenditure for the assets is being incurred. When expenditure for the asset is being incurred, it should be capitalized. When borrowing costs are being incurred, it should also be capitalized. And number three, which I would like you to remember because we talked about qualifying assets earlier, is that the activities that are engaged in to prepare the asset for its intended use or sale is in progress. So these three conditions must be met. Number one, expenditure for the asset is being incurred. Number two, borrowing costs are being incurred. And number three, any activities that are engaged in to ensure that the asset is prepared for its intended use or sale are in progress. If any of those activities are in progress, then we go ahead to capitalize borrowing costs, or we begin to capitalize borrowing costs. That's what we mean by the commencement of capitalization. The commencement of capitalization. This is very, very crucial to understand. Now let's look at borrowing costs in terms of the rate of interest, right? When we say borrowing costs, right, if you go to a bank to go get money, it comes with a cost. Other people call it interest rate. Some people call it finance costs. You can also call it borrowing costs. It comes with a cost. It's not free, So where funds are borrowed specifically to acquire qualifying assets, if you go to a bank to get money to buy, let's say, and use that money to buy, let's say, some form of plant or equipment, you use specifically those funds to acquire qualifying assets and plant or equipment, then borrowing costs must be capitalized, or borrowing costs must be capitalized in that regard. So where funds are borrowed specifically to acquire qualifying assets, borrowing costs which may be capitalized are those actually incurred. In that case, you can capitalize the borrowing costs. You can capitalize the borrowing costs. That's very, very essential. So let me just read what we have here. Where funds are borrowed specifically to acquire a qualifying asset, borrowing costs which may be capitalized are those actually incurred, less any investment income on the temporary investment of the borrowings during the capitalization period. So if there's any investment income that you gain from the temporary investment of the borrowings, so let's say you go to a bank, you say you want, let's say, $500,000 to purchase a mega plant, that would help you to produce your products in your factory, right? You go there, you get these funds. Let's say they give you an 8% interest, they give you an 8% interest, but you do not use the funds to buy the plants immediately. It takes a while maybe to search for a good manufacturer of the plants and all that, or even shipping the plants to you and all that. So maybe the money you borrowed, you put it in the bank and it earns some interest. That's what we call the investment income on the temporary investment of the borrowings during the capitalization period. So if there's any investment income you earn on the temporary investment of the borrowings during the capitalization period, that should be taken out of the borrowing costs. So let me read again. It says, where funds are borrowed specifically to acquire qualifying assets, borrowing costs which may be capitalized are those actually incurred, less any investment income on the temporary investment of the borrowings. Very, very important. Very, very important. So once you go to the bank to get a loan to go and buy, a qualifying asset, that borrowing cost should be capitalized. It should be capitalized. Now let's look at something here. If an entity had a 10 million 6% loan and a 2 million 8% loan, then we will need to calculate the weighted average cost of borrowing. And the weighted average cost of borrowing in this case will be 10 million times your 6% plus 2 million times your 8%, all over the total loan, which is 10 plus 12, which is 12 million. So when you do your calculations, you should end up getting 6.33%. So the amount to be capitalized as borrowing costs would be 6.33% times the amount spent on the assets. Very, very important. Very, very key. Now let's look at cessation of capitalization. At what point do we stop? We talked about commencement of capitalization. If you remember, we talked about expenditure being incurred, the borrowing costs being incurred, as well as any activities that help to prepare the assets for its intended use or sale are in progress. These are the three conditions when it comes to commencement. So let's talk about cessation. Capitalization of borrowing costs should cease when either substantially all the activities necessary to prepare the qualifying assets for its intended use are complete. When we are talking about commencement, we said those activities should be in progress. Here, in cessation of capitalization, all those activities that are required to prepare the qualifying assets for its use or sale are complete. They are all complete. Or another point where we cease capitalization is when construction is suspended, which may be due to several reasons, including industrial disputes. So this is something that I would want you to take note of. This is the theoretical foundation of IAS 23 borrowing costs. I hope you enjoyed this lecture and see you in the next session on IAS 40 investment property. Thank you very much and have a good day.